In this video, we're going to discuss what is a DST, why would someone use a DST, invest in a DST, and how would they exit a DST. So to begin with, what is a DST? A DST is a Delaware Statutory Trust. It's a trust structure that has a revenue ruling with the IRS 2004-86, where basically it states if the trust follows the IRS guidelines on a particular structure, the DST structure, any real estate that they buy in the trust will qualify as like kind for Section 1031. Now that we've kind of covered what a DST is, we now have to say, why are these big real estate investment firms using a DST to syndicate real estate? And the reason they use it is because a couple of things. Number one, obviously, if they follow the structural guidelines by the IRS, they know that an individual can come in and buy a fractional position within the larger trust and use that fractional membership interest in the trust as like kind for their 1031 exchange. But more importantly, besides that, it's the fact that they can also allow up to 2,000 investors, and the investor is kept passive in the deal, in the real estate, while still getting the pass-through qualities that are associated with real estate income. They get the deductions, interest deductions, and depreciation deductions. So now we have a product that provides the very large real estate investment firms a great vehicle to syndicate real estate that they want to manage. So now we're at the point where, why would an investor want to use a DST? Well, the investor is going to want to use the DST when they've encountered different issues or different circumstances in their life. Typically, we see a lot of investors that no longer want to manage real estate, but they still want to defer all the capital gains and depreciation from the sale of their real estate. This provides a great venue for them to accomplish doing a 1031 exchange, buy investment real estate, get exposure. Now, one of the things, if you have $1 million or $2 million, you're not going to have Amazon or Uncle Sam as your tenant. So by leveraging the DSTs, an individual investor can diversify their investments. They can get exposure to institutional grade and quality properties along with institutional grade and quality tenants, all while receiving their monthly income and share in the appreciation of the property. So this is a great vehicle for the sponsor as well as the investor in terms of completing a 1031 exchange, investing in real estate, getting their monthly income, and then when the property's sold, share in the appreciation of the property. So DSTs are a great option. They should always be considered. I like to tease that they're door number 3, because when an investor is selling a property, their first choice is to sell the property, pay the tax. Choice number 2, sell the property, go out their own replacement property. They're burdened with the fact that they have to match, debt and equity. So if they sell for $1.25 million, they have to find the property for $1.25 or greater. And then they have the option of door number 3, the DST, where not only can they match the debt and equity, we can match them down to the penny. So if the client sold for $995,412.09, well, we can match them right down to the penny, and at the same time, we can break that $900,000 plus into 3 or 4 investments and create a diversified portfolio. So that helps today. Obviously, if you have any questions, feel free, reach out to us. We're happy to help.